Now I'd like to walk you through the 6 broad categories of financial instruments and tools that are listed in the initial 2-year work plan of the Executive Committee. These categories from the top are 1, comprehensive risk management capacity with risk pooling and transfer, 2, catastrophe risk insurance, 3, contingency finance, 4, climate-themed bonds and their certification, 5, catastrophe bonds, and finally the 6th, which is the very mysterious, other innovative financing schemes for the types of climatic events and hazards which conventional tools may not reach. These broad categories of instruments seen here are applied at different levels. Across the world, regional, national, and/or micro. I'd like to briefly discuss these categories and their merits and limitations in addressing the risk of loss and damage. On this slide, we see various instruments and tools that fall under the categories of transfer, risk pooling, and catastrophe risk insurance. Just a couple quick points here. On the top, we have risk transfer and pooling mechanisms. These tools help to spread losses widely across time, stakeholders, and/or geographical areas, but we also note that they are largely suited for rapid onset events and less applicable for slow onset events or events with very high frequency. In addition, regional risk pooling requires high levels of regional cooperation and solidarity. At the bottom, on the left, we have catastrophe risk insurance, a subcategory of risk transfer. Catastrophe insurance guards against insolvency when major catastrophes occur, such as through rapid payouts. Finally, bottom right, we have index-based schemes, which rely on indices rather than damage assessment after an event. This method allows rapid payments post-event and can offer lower insurance premiums because of the lack of damage verification requirements. Both of these are factors that can increase the value of this financial tool to beneficiaries. This slide shows various categories of bonds. Again, I just want to draw your attention to a few points. Their use has been limited in developing countries to date, and I reiterate that since highly indebted countries and other poor countries may not be able to face potentially high associated interest rates, the use might be limited. Ex-post bonds are set up to finance recovery, and catastrophe bonds are, to date, only offered to institutional investors in industrialized countries. Again, developing country experience is limited. On this slide, we see a first set of instruments that fall under contingency finance, namely microcredit, microsavings, and microgrants. These are usually designed for low-income households and communities. A challenge is that the value proposition of long-term planning and investment to protect against climate risks can be difficult for households facing more immediate challenges related to health, housing, food security, education, etc. Also, for very low income, below the poverty line households, savings potential is limited related to the magnitude of some climate stressors like droughts or storms. On this slide, we summarized a second set of instruments and tools that fall under the category of contingency finance, namely social protection schemes, disaster relief funds, and contingent credit. Take note that in the case of social protection schemes and disaster relief funds, here along the top, they are often financed or co-financed by national governments, often with multilateral participation and donor support. Stability of funding is a key challenge for these approaches. It is worth noting that linking social protection with insurance could improve the efficiency and cost effectiveness of both financial instruments. And we've seen some evidence of this with the R4 initiative in Senegal and Ethiopia, for example. Finally, as we have seen with other instruments, contingent credit has the downside of potentially increasing debt levels of highly indebted countries.